Good morning and welcome. We are delighted you are in attendance for this informative conversation entitled The 1 Hour Banker, How to Evaluate Private Equity Investments Like a Professional. This is Kim Casleonis, the founder and managing partner of Breakaway Funding, LLC, and the former CEO of Circle Bank, a successful franchise built on trust and innovative partnerships with our clients and our community. To help set your expectation this morning, I will begin with a brief description of Breakaway Funding and its services, followed by a short audience, that's you, participation poll. I will introduce our presenter, we will allocate some time for questions, and we'll close up with some wrap-up thoughts. At Breakaway Funding, we are spearheading an innovative platform that brings the same commitment to a new and thriving online investment community we call the Community Capital Marketplace. The engagement of all members of our communities, investors, business owners, entrepreneurs, and community financial institutions collaborating to ensure capital is made available to propel innovation, job creation, and provide new opportunities for investors like you. Our platform is a complete capital raising and investing ecosystem providing a standardized process for raising capital, leveraging technology to help drive down costs for issuers, a comprehensive and transparent due diligence documentation system, and analysis tools, one of which we will be reviewing today, to help you make informed investment decisions through a secure, convenient, and regulatory compliant website, and providing community banks and commercial credit unions with a steady stream of new client relationships. Everyone should have access and the ability to invest in startups and early stage companies they believe in and whose mission is aligned with their values and in which they are legally eligible to invest. To help you prepare for and participate in this exciting new marketplace, we provide a full complement of services and support from free educational webinars like today's event to post-raise investor relations care. Now, I could go out on a limb and guess that the reason many of you have joined us this morning is because you suffer from that disease called analysis paralysis. That you want to participate in private equity investing, but you don't have the foggiest idea of where to even start a proper analysis, what to look for, and what those figures mean. Well, help is coming. But before we get started, we would like to know by a show of hands how many of you are already investing in private equity, and if not, why? Please answer these questions by typing your response in the conversation box on the right-hand side of your screen. David Perticone, Communications Manager for Breakaway Funding, will provide us the answer to your questions later. Again, those questions are by a show of hands or a show of cyber responses. How many of you are already investing in private equity? And if you're not, please let us know why. Well, as I mentioned, at Breakaway Funding, we provide investors with the tools and education to help you make more informed investment decisions. One of those tools is called ProfitCents, a financial projection, historical analysis, industry comparison, and accompanying narrative report software. Powered by one of the largest databases of private company financial information in the United States, ProfitCents, while used by accounting and other financial professionals, is being made available to investors on the Breakaway Funding platform. To help us better understand how to evaluate private investments like a professional and to effectively use the ProfitCents tool, it gives me great pleasure to introduce you to our guest presenter this morning, James Lichau. Oh, there's the poll. And here's James. James Lichau, Assurance Senior at Burr, Pilger, and Mayer CPAs. James is a professional in the public accounting arena. His clients include for-profit and not-for-profit organizations. He has worked with companies such as Prosper Marketplace, LendUp, DemandBase, and numerous other startups, and has provided key insight to the Bay Area's tech industry. A fellow accounting major, he is a member of BPM's Audit Methodology, Technology, and Best Practices Committee, as well as BPM's financial services industry group leaders. It is with great pleasure that I turn the mic over to James.
Thank you, Kim. Good morning, everyone. As Kim mentioned, I'm James Lichau, and I work with BPM here in San Francisco. First, I'd like to thank everyone for joining us today, and at the end of the presentation, I hope you're able to take away a better understanding of some of the tools that we can use for performing an analysis on a potential investment, and hopefully some perspectives on some things to look at through your investment process. Before we get into learning how to use ProfitCents and our example scenario, I'd like to take a minute to highlight some things about BPM here. With 43 partners and about 400 professionals, we're proud to be one of the largest California-based CPA and consulting firms in California. A nice thing about our firm is we're also part of the Leading Edge Alliance, which is a network of about 215 similar firms, in roughly about 100 countries worldwide. To the right, you can see some of our accolades that we've recently been awarded, such as ranking among the top 100 accounting firms in 2015 in the West from Accounting Today, and ranking in the top 10 best places to work in the San Francisco Business Times and Silicon Valley Business Journal. A little bit about our firm overarching methodologies. We really like to help our clients achieve success. We like to position ourselves as business partners to help our clients work through their issues and come out with things that they need to continue successful goals and operations. At the bottom of this slide, you can see some of our industry groups, such as the consumer products, financial services, and life sciences, just to cover a few. Our assurance approach, our methodology approach, which is also kind of known as our audit methodologies, we like to take a deep understanding of your business and your company and allow us to develop a focused, efficient, and risk-based audit. This allows us to identify the true challenges that you're facing and help you come up with solutions to those issues from a financial reporting perspective, as well as sometimes a consulting component as well. As I mentioned earlier, we also provide consulting services, and here you can see that there's an array of consulting services that we do, and we also focus on private equity and venture capital funds with these types of services as well. Our M&A support services group provides different advisory support for an array of different types of transactions, including some of them listed here as business evaluations, growth strategy, and mergers and acquisitions. I'm sure everybody loves the mergers and acquisitions. Those are really fun things. However, we're pretty good at it, so we like to pride ourselves on the expertise surrounding those areas. Some of the leading investment firms that we like to partner with, and we've done certain consulting and M&A work for, are seen here, just to name a few. And then some of our other client engagements here, these are going to include audit engagements, consulting, and sometimes tax work as well. Okay, so enough about the BPM. Why are we here today? As Kim mentioned earlier, we want to learn how to essentially invest like a professional. Now, depending on everybody's level of involvement with investing in private equity or startup company perhaps, what are some of the terms that you've heard of or some of the aspects of the investing that you've heard of when you think about the investing arena? Perhaps it's income statements, historical trends, leverage. CMRR is a very popular one amongst the tech companies. Concentrations, cash burn, valuations, asset composition, earnings quality perhaps. The point of all this is that when you get into investing, it can seem rather complex, and let me assure you, it very well can be complex. However, there are tools out there, as we mentioned earlier, such as ProfitCents, that can help us simplify our investment decision. Okay, So today, what we're going to do is we're going to look at some financial statements, and I'm going to provide some background and some insight on how to read and use financial statements. Then we're going to plug that information into ProfitCents and create a working model that we're able to adjust and change for any kind of expectations that we might have, and as well as kind of interpret those results. What we're going to be, our overarching goal here and our overarching point of all this is that we're going to look at historical trends with our working model. We're going to look at some analytics, and like I said earlier, we're going to look at some projections, which all hopefully tie into helping us make this decision. So first, we're going to start off with navigating financial statements, and then we're going to perform an analysis of a startup company that I've chosen, and we'll go into the details of the type of company that we will be looking at. And we're going to interpret the results as well as adjust our expectations and reinterpret our results based on our adjusted expectations. Okay, so this is going to lead me to my scenario. So picture us in this situation. We previously worked at a startup that went public. We've made our money, and instead of buying the Ferrari, the beach house, or the private jet, we've made the smart decision to invest in a company. Now, I guess you can probably tell what I would do if I was in this situation with the Ferrari or the beach house, but we're going to go ahead and make the smart decision here and go ahead and invest. So we've also selected a prospective company to invest in. However, we're at the point where we're really not sure how to evaluate it properly, whether or not we want to put money into it, or how long it might take us to get our ROI back, return on investment. So that's what we're going to look at today. Here are some details of our prospective company. We're looking at a tech company, which is, they are a software as a service, also known as SaaS. They're still a startup, 5th year of operations. As I said, they're in the startup phase, so they've yet to be profitable. However, they've done extremely well from a debt and equity capital financing perspective. They've also done extremely well with their growth trajectory because sales have increased approximately 40 to 50% each year since inception. The ultimate exit strategy is to sell the company upon profitability. But first, to be able to reach profitability, they know that they need to increase the customer base as well as some customer current retention rates and the cash flow positions. We're going to answer later how this is going to be achieved. How does management think that they're going to be able to do this? And I want to preface this briefly to say that, in a real situation, you may or may not have this information available. But for today, and to illustrate the use of ProfitCents, we're going to assume that we know these things, and we're going to apply changes to our model based on these factors. Okay, where do we start? We're going to start with some financial statements, which, as a reminder, financial statements outline the activities and present the financial condition of a company. Now, financial statements you'll see in the market are going to be typically 1 to 2 years. You'll see a single year, which will be just 1 year of operations, or you might see what are known as comparative financial statements, which would cover 2 years. Now, say your company that you're looking at to invest is a public company. This information is readily available on the Securities and Exchange Commission of the SEC's website. I've provided the SEC website here just in case you guys want to look at anything after or later down the road after we're done with this presentation. Now, what's a little more tricky with a private company is typically their financial statements aren't necessarily published publicly. There's certain ways you can get it depending on what the company likes to do, such as they may publish their financial statements on their website, or perhaps they put out an annual report in which a lot of the times the annual reports for these companies will have financial information or a very close interpretation of the financial statement in which we can use that data for ProfitCents. Now, if you're lucky enough or you have a good enough relationship with management or perhaps some of the other investors in companies like these, there's always the route of asking for the financial statements that way because you can tell them that you're a prospective investor but you'd like more information on the company. That might be more rare in certain cases, however, it definitely does happen as well. Okay, Before we look at these financial statements that are going to be coming up, I want to just explain what we're going to be using for our model. So here we have a description of the balance sheet and the statement of operations. Now, kind of as a refresher, the balance sheet is a financial statement of the company's assets, liabilities, and capital. The capital piece on a true set of financial statements is going to either be called equity or deficit. Now, one important aspect to realize about the balance sheet is that the numbers on the balance sheet represent a snapshot of a point in time. We'll see in a second that there's a difference between point in time and period of time with the statement of operations. But this is essentially saying at this point in time, the company owns this, which are the assets, the company owes this, which are the liabilities, and the amount invested by the shareholders of this company represents the capital or the amount put in by certain investors. Looking at a set of financial statements, you might also see the balance sheet called the statement of financial condition. Moving on to the statement of operations. This statement essentially summarizes the company's revenues and expenses for a certain period of time. Typically, you'll see it be 1 year. Now, the key distinction here is that a statement of operations covers an entire year's worth of revenue and expenses. So, for instance, if the financial statements are dated December 31st, 2013, the period of time or the revenues covered under the statement of operations are going to be from January 1st, 2013 through December 31st, 2013. As opposed to the balance sheet, the numbers on the balance sheet are going to be those numbers at December 31st, 2013. Another important aspect of the statement of operations is that it's going to provide the company's net income or net loss. So what did the company earn at the end of the day after all of the sales were made and all of the expenses were paid? What was the ending amount that they retained or what they lost? On other sets of financial statements, you might see this be called the income statement, the profit and loss statement, or a P&L for short. Okay. Here is an example balance sheet. Now, there's one important thing to note between this slide and the next, and I'm just going to switch to this slide very briefly. Okay. You'll notice on the first slide it was assets, and then on this slide it's going to be the liabilities and stockholders' deficit. The reason I wanted to point this out is because in any financial statement, and most of you might know this already, but the assets are going to be on top of the liabilities and stockholders' equity. I had to split it up here for illustrative purposes on the slides, but I just wanted to make that distinction as we go through this so that everybody was on board with me. Okay, so here we have a comparative set of financial statements, or a comparative balance sheet in this specific instance, for 2013 and 2012. And moving on into the rest of the balance sheet again, 2013, 2012, the same financial statement, same balance sheet. And here we have our liabilities and our stockholders' equity. Okay, now moving into the statement of operations. So same thing, a dual year, or a comparative year, 2013 and 2012. And we'll notice that here are the revenues and here are the operating expenses, and then we shake out to a net loss of about $10.4 million. This is going to be used in a little bit to show how we import this data into ProfitCents. Okay, now we have our ProfitCents template. So to give you a little background on this slide, when we use ProfitCents, we have to get the data into it. And so what this represents is this is an Excel template that ProfitCents provides. And what you simply do is you can see here that this is balance sheet data, and then you can see the current period, which is the 12/31/13, and the prior period for 12/31/12. You're going to simply plug in the numbers from the financial statements as you see them, where the line items match up, so cash, accounts receivable, other current assets. Now you might be wondering, what are these blank columns off to the right? Well, ProfitCents allows you to put multiple years of data into the system to be able to create your model. Now, in our case, we're only using 2 years. However, in any instance that you might have more information and you find yourself using ProfitCents, I highly suggest you enter that information, because the more years you have historically, the more accurate your projections are going to be once you start to run the model. So this is going to be similar for the income statement. We pull the information right off the income statement. And similarly, here's your 2013 and 2012, and then your historical periods here. Okay, at this point, before we move into working with the model, does anybody have any questions? Or David, did any questions come up during this first piece?
Yes, James, we have a couple questions here for you, but first, going back to the poll, it looks like about 10 people are currently investing in private equity. So the two questions we have here for you, the first one is, if I was able to obtain the internal financial statements, should we use those?
Great, good question. Okay, so that's a good point. Sometimes these companies, perhaps in the early rounds, such as a seed phase, they might not have formalized financial statements, but they might have an accountant or some kind of accounting reporting person in place that's preparing some kind of financial information to report to the board. Now, while it's going to be okay to use that information, because if that's all you have, then I would still go with it. However, in any instance that you're able to get an audited set of financial statements or even a reviewed set of financial statements, that information is going to likely be much more accurate than internally prepared. But it is okay to run analysis on internally prepared financial statements because it still should give you a core idea of where the company is at a certain time.
Okay, and we got one more question here for you, James. What if we wanted to analyze multiple companies next to each other?
Right, great. So what we'll see here in the next couple of slides when we run our projections, what's nice about ProfitCents is it's going to, once you hit the button to create the model, it's going to put it in Excel. So you're able to save the Excel sheet outside of ProfitCents. So what you'll be able to do is run multiple companies within ProfitCents, and you'll be able to put these Excel sheets up next to each other to analyze from a comparative standpoint. Good question. Okay, so if that's all we have, we'll go ahead and move on into the working model that we've created in ProfitCents. So now assume that we input the data into ProfitCents and we've created our model. Now the first thing that we're going to see, and you can see here that this chart below is from ProfitCents. ProfitCents maps out the trajectory of the company based on the historical information that we've put in. So for instance, the sales growth is about 46% based on the 2013 and 2012 financial statements that we imported. You can see the gross margin at 78%, and then overhead growth at 34%, and so on and so forth. One important thing that we'll come back to later are the accounts receivables days. Now, this is in reference to a certain analytic regarding cash flow. It's the accounts receivables days outstanding, and what this represents is what is the amount of time it takes the company to collect on its receivables from the point at which the customer is billed to the point at which the cash comes in the door. So similarly with accounts payable, what's the amount of time it takes the company to pay its bills from the point at which the invoice is received in the mail to the point at which the check goes out in the mail. These are going to be important later, but just pay attention to these for now and know that this is calculated right off of ProfitCents, right off the information that we're given on the financials. So moving into the projections. Now, this is another report right out of ProfitCents, and what we can see here is I pulled the income statement piece of the projection. Here's our 2012 information, here's our 2013 information, and now to the right you can see 2014 through 2018. This is going to project the expected expenses and revenues based on the line items of the statement of operations that we put into ProfitCents. One of the most important things to note here is when we come down to net income, if you can see off to the right of 2018, as of the current trajectory as of 12/31/13, these guys are still not going to make a profit 5 years out. Now this is important to note because if it depends on your risk appetite for what you want to invest in or what your expected turnaround is for your return on your investment. ProfitCents is also going to allow us to look at some ratios. So here I've pulled the current ratio and the quick ratio. And overall, what the current and quick ratios do for us is it essentially it's an indicator of how liquid the company is and what is the company's ability to pay its short-term liabilities in the near future. So we can see here for 2012, for the current ratio, 0.73, and then we work up to 1.2 in 2013. Now, it's always a good thing to see the current ratio increasing. We will see an exception later on in the slides, but there's a very interesting reason why as to what we'll see. There's also this benchmark column. Now, I didn't talk too much about the benchmark in the first place because I wanted to really focus on ProfitCents' projections and analytics. However, there's also, and I believe Kim mentioned this in the beginning, there's a benchmarking function within ProfitCents. When you're going through the import of the data, you're able to put in the type of company that you're looking at. What this is going to do is it's going to pull from their database of other like companies and put together average metrics or average projections and standings of these other companies, and it's going to allow you to compare your prospective company to what ProfitCents' benchmark is. So you can see here, for instance, this type of company is quite a bit below the benchmark. However, in our case, that's okay, because remember, these guys are still in their startup phase. They have yet to turn a profit, so they're still kind of growing into their own. I assume for this instance that a lot of these companies that are driving the 2.1 current ratio benchmark are going to be rather established companies that have grown into their operations and are hitting their earnings stride. Okay. Another important metric that I pulled from ProfitCents is going to be the return on equity and the return on assets. This is the primary reason why we're investing into a company, and one of the things that I would assume we would most likely be monitoring consistently. You'll see here that based on the 12/31/13 trajectory, these guys are quite a bit negative on the return on equity as well as the return on assets. Now, this obviously makes sense because they have yet to make any kind of profit, and so with consistent losses every year, accumulating the deficit, we're going to see these be negatives until we see them turn a profit. So another great aspect of ProfitCents is that it pulls a narrative. So when I look in ProfitCents, there's a section in here for the current profits. Now, ProfitCents is going to put together a narrative to try to help you understand what you're looking at in terms of the trends, expectations, things to look out for in the nature of the operations of the company, and also things to remember as you perform your analysis. Now, I'm not going to go through and read this altogether, but it's a great tool that if you see something interesting perhaps in one of the metrics, you can read this and it might explain it for you. Okay, so now we've looked at what the current trajectory is, like I had mentioned, and let's go ahead and update the model here. So we have some information from management that we know that the company is going to make some changes in the coming year or two. One of these changes is going to be an additional office location. They want to put an office in New York. They also want to increase the office space at their headquarter office in San Francisco, as well as expand the sales team and offer a new product. Now, obviously with expansion comes greater costs. So while they do expect sales to increase from the additional sales team and the new product offering, we have to keep in mind the cost that's also going to drive as well. And another component that they want to do is they really want to increase or improve the nature of the cash flow. So as we looked at earlier from the similar slide based on the historicals, the accounts receivable turnover was quite high, and the accounts payable flow was also quite high. So what they wanted to do was kind of bring the cash flow or the internal cash flow more in line with collections and the cash in and outflows. So, okay. So one important thing to note, now we've changed the sales growth bar because I mentioned earlier we can actually make these changes. I went ahead and assumed that the sales growth with these changes is going to jump to 60%. I left the gross profit margin the same, and the overhead growth, I increased it to 40%. Now, like I just mentioned a second ago, you can play around with these. You can model and adjust these expectations however you wish, and you can run the model multiple times. So it's important to note that, but we're just going to go ahead and assume these changes for illustrative purposes today. Now, coming down to the accounts receivable days, they'd really like to tighten up the cash collections, and so they're going to shoot for accounts receivable days outstanding to decrease to about 60 days. And the accounts payable turnover, or accounts payable days outstanding, they really want to decrease that to 45 days. They want to improve the relationship with the vendors, and they really want to bring their cash disbursements a little more in line with their cash collections, making the internal accounting process a little smoother for them. Okay, now that we've implemented these changes, we're going to rerun the projection. Here's that similar projection slide as we looked at earlier with your 2012 data here and your 2013 data here. Again, we look at 2014 projected out to 2018. Now, one of the most important things I think to note on this slide here is with these changes that we've made, now we're expecting these guys to turn a profit in 2018, which is a big difference from what we looked at before where they were still turning a net loss in 2018. Another aspect of this is that we can pull charted results to give us a little more illustrative example. Now here we're looking at the sales and revenue, cash, and net income trajectories over the next 4 years. And you'll see here that the turquoise or blue line is going to be your sales, the purple is cost of sales, the red net profit, and the cash is green. Now, it's probably obvious here there's one of these items that kind of looks, a little off or odd perhaps. Maybe you're thinking it's the cash. So here we notice that cash spikes in 2015, decreases down in 2016, spikes again in 2017, and decreases down in 2018 again. So you might be wondering why this is happening. Well, remember, again, these guys don't turn a profit, but remember in one of the earlier slides that these guys have been very successful at raising debt and equity to get capital in the door. Well, ProfitCents realized, based on my projections that I put in from my historical data, is that these guys will likely burn through their cash reserves as of 12/31/13, and they're going to need some more financing at some point. So based on the historical based on the historical nature of what these guys have been doing, they're likely going to need to raise funds in 2015. They will likely burn through that in 2016, raise again in 2017, and burn again in 2018. Now, you'll notice also that the spikes and the decreases are happening a little bit more rapidly, but that's also because our sales are expected to increase 60% or so every year. So along with the expenses, so your cash burn is obviously going to elevate in accordance with that as well. Now, another important thing to note, if we were to take 2018 and project it out another 5 years, I would expect this cash line, the movement of the cash line, to start to fall more in line with your net profits. Because at 2018, if you remember, we are expecting a net income, and so once they start creating income or earning income over that period of time, they're going to start stabilizing out. Let's revisit the current ratio with our projections, and now you'll notice that the current ratio here falls, and that's again because of what we just discussed about the cash trajectory. They're expected to burn through their cash during or at the end of 2018. So with a depletion of the cash, this is going to drive their current ratio down at the end of the year. Whereas starting in 2013, the cash position was better off than it would have been in 2018, just simply based on the cash burn expectations. Similar, we can see with the quick ratio, same nature. These ratios are very closely interrelated, so we would expect that the behavior of both of them from our projected standpoint to be very similar. Returning now to the return on equity, we can see that they're essentially at a break-even point in 2018 now, whereas in our prior slide, we were projecting a pretty significant negative return on equity. Now, this is likely because they have begun to turn a profit now. However, they've accumulated quite a large deficit over the years of operations. So it's going to take a little while to essentially gain or earn a return on the equity that has been put into the business over time. However, at 2018, it's not going to be considered negative anymore since they started to turn a profit, a positive profit. And we also can see the return on assets spiked positive at the end of 2018, and this is also going to be driven off the positive net income. Now, the return on assets essentially is telling us how is the what kind of profits or what kind of earnings is the company generating off the assets that are deployed in operations. Now, one important thing to note that is very typical with SaaS companies is sometimes, or most of the time, their largest asset is going to be capitalized software or capitalized website development costs. As they go down the road to profitability, you can see sometimes that these will either spike as they continue to build out their websites or platforms or what they have in the like type assets, or they might stable off. They might have hit the point where they've brought their product to market, and the additional work that they do on the platforms are maintenance and repairs that don't get capitalized. So once they turn a profit, all of a sudden now you're getting a big return on your assets because your assets are being deployed and earning you net profit. Again, now that we've ran our projections, we're going to look at the narrative that ProfitCents will provide to us. And this is, again, the narrative on the profits. Now, the one important difference here that I think is a pretty cool aspect of ProfitCents is it's going to give us a warning note. We're going to see that what ProfitCents is telling us is that now that these guys are earning income, we got to keep in mind that now income taxes are going to come. So it's a very good thing to keep in mind, and it's a really good flag for us as an investor if we're trying to see all different aspects or as many aspects of this company as we can. ProfitCents is going to help us simplify this and put this into a perspective. Okay. Does anybody have any questions on the projected model that we ran?
Yeah, thank you, James. We have a few questions coming in here. The first one is, I've seen a full set of financial statements before and noticed other statements, such as a statement of stockholders' equity and cash flow. Would these be used in ProfitCents analysis?
Good question. So in most of the ProfitCents that you're going to, the analysis that you're going to do, I would not use those. ProfitCents doesn't ask for these statements. However, it's good to get a feel for the cash movement from a cash flow perspective. And really what the statement of stockholders' equity is going to do for you is it's really going to drill into the equity or the portion of the balance sheet that shows what the investors have put into the company. It's really going to drill down into those details and break that down. So the most important information that we need to use for our projections and our analytics is really going to be captured on the balance sheet and the statement of income.
Okay, and we got another question here for you, James. For the company's operational plans, how would we know that any one change in the company will affect revenues or expenses, and by how much?
Great. Yeah, that's a really good question. And as I noted earlier on, when we went to make the adjustments, we may or may not know what the effect of these changes will be. But what the nice thing is similarly to when I answered the question regarding the multiple companies comparison, what we're going to be able to do is you can run a projection based on certain expectations, put it into Excel, save it, and then run another one. So what you can do is you can essentially play around with the projections and say, okay, well, if these guys open a new office or if these guys double their sales force, and maybe that's a 50% increase in sales. So you can put that into the increase in sales and see where those projections take you. Or maybe you can say, well, I don't think that they're going to really, increase sales by 50%. Maybe it's more like 35 to 40. Well, you can run both 35 and 40, get those projections, and put all three next to each other to see kind of where that would fall out.
All right, and we got one more question here, James. Why is analyzing cash flow important?
Cash flow is important because you want to know how well the company is using the cash. So you don't want the company burning through cash faster than it can either make it in operations, or essentially you want to know how fast they're leading into the next round of financing. Now that's important because from a dilution standpoint, if you put money into a company and you buy stock, the more stock they issue subsequent to you putting money in, your ownership essentially has the risk of being diluted. So, personally, I like to just see how well cash is being managed. However, from the operational standpoint, in terms of revenues and profitability, it's not an extremely large component of that aspect.
Okay, and those are all the questions we have. At this point, we will take it back to Kim.
Thank you so much, James. What a very informative and exciting presentation that you provided for us today. We hope you've enjoyed our presentation. Just to kind of recap some of the highlights, at least from my viewpoint. There we go. One, there is a solution to analysis paralysis. It is called ProfitCents. And ProfitCents, as James described in pretty good detail, allows you to change the business plan assumptions of a company that you are considering investing in, and it allows you to understand how that company's financial performance or financial projections compare to other companies in their industry. So it's a very powerful, very flexible analytical tool that is, notwithstanding all those numbers looks pretty confusing, is very user-friendly. And one of the other very cool things about ProfitCents is it is available to all Breakaway Funding investors. Every single one of our offerings include in the due diligence documentation the financial projections, and we have already uploaded or populated ProfitCents with the company's financial projections. So you will have access to the sensitivity analysis tool, or your ability to change up to 8 different business plans assumption, whether it's growth rate, expense rate, so that you can get comfortable with the prospective investment operating cash flow and profitability to help you make a more informed investment decision. Again, at this time, I'd like to take a moment to thank our presenter, James Lichau of BPM, and for providing this information, this informative session about how to use ProfitCents financial tool to help us analyze our investment opportunities. If you have additional questions for James, his contact information is available in this presentation. We will be sending you a copy of this presentation in a post-webinar link, so you may review at your leisure, and certainly give him a call if you have any questions. We will also be sending you a brief survey, not only to provide feedback on this event, but to also let us know what kinds of other educational webinars you would like us to bring. We invite you to our upcoming events. Next month, we'll have How to Pitch Your Deal, and the following month, Developing Your Exit Strategy. So please visit us at breakawayfunding.com to sign up for any of these events. We thank you all for joining us today. Again, we hope you found it valuable, and we welcome you to the Breakaway Funding community.